Every single massively successful startup I've seen has had multiple near-death experiences where they were running out of cash, something went horribly wrong, they lost an important customer, whatever it is. And if you don't have the resilience to push through those moments, you're going to be tempted to give up, and then you'll never know what you could have done. One of the reasons we set up Transition was to demonstrate by doing that there's no contradiction between doing the right thing, especially for the planet, and doing really well commercially. The most dangerous failure mode in building a business, I think, is indecision, right? And sitting on decisions for too long. And that way you don't learn, because you learn from your mistakes, you learn from good decisions and bad decisions, so you should just be making as many decisions as you can. The only way to solve some of the biggest problems we face is by developing better, cleaner technology with integrity. And if we don't have people with high integrity working on the technologies that are going to shape our future, those technologies are going to be shaped by people that don't necessarily have the best interests of the planet, of society at heart.
So Ari Helgason started his career the way a lot of people in venture often don't. He built something first. He co-founded Fabricly, a fashion tech startup, through Y Combinator, and Woa, a cloud ERP platform for apparel companies that was eventually acquired and rebranded as Uphance. He wasn't observing founders from the outside. He was inside the machine, being one himself. From there, he moved into the investor seat, first as a senior associate at Dawn Capital, then a principal at Index Ventures, before co-founding Transition in 2021 alongside his brother David Helgason, founder of Unity Software. Transition describes itself as a home for builders, scientists, and investors, people accelerating the inevitable transition away from the systems that powered human progress, but are now, in their words, out of date, out of control, and out of time. The fund backs founders making the impossible inevitable, those undeterred by bureaucracy, supply chains, and the passing of time. Portfolio companies include Olix, Upway, Seneca, and HeatGeek. The teams operate from London and New York, and Transition just closed its second fund, 128 million euros. Total assets under management now just north of 257 million euros. Their own words on the industry they're operating: the classic VC model of backing more of the same, incremental improvements, has run out of the road. Ari holds a first-class BSc in International Relations from the London School of Economics. He's the kind of investor who knows what it costs to build because he's learned it from the ground up. And more, he's driven by the bigger purpose, supporting founders, scaling startups, and pushing innovation that matters and contributes to a better and more sustainable world. Ari, welcome to the Sacred Art of Leadership podcast.
Thanks for having me.
Wow. That's an intro, man. It's impressive. Standing start to just north of 257 million euros.
Exactly.
How does that feel?
Look, it's always quite, gradual and incremental. So by the time you get somewhere, you're kind of mentally on to the next thing, right? So I tend not to take much time to sit down and think about where we've gotten to, because there's so much more to do. But when you say it like that, it feels good.
You've done a lot in a short period of time, it seems to me. You're still quite young. Have you overachieved what you expected for yourself?
I think one of the keys to being happy is not having massive expectations. So I do have high standards and set a high bar for myself. I just turned 40, so that, obviously leads to a lot of soul searching. But I'm very happy with where I am. I think, it's been a meandering journey, but a fun one.
So we always ask our guests, and they come on, they are open a question, which is, when you hear the title, The Sacred Art of Leadership, what it means or says to you?
That's a great question. So, what is sacred? Sacred is something that, inspires or requires reverence, something potentially divine. I think when I hear it, I think of leadership as, something that has with it, or that entails a lot of responsibilities, right? You're responsible to the people around you. You're responsible to the people that entrust you with their careers, their working lives, in my case, their capital, or in the case of the founders we work with, the well-being and the thriving of their companies, right? So I think, that requires a lot of responsibility, and you have to respect and revere that, right? That trust that you're given.
When you say it like that, and the way you say it's quite interesting from a VC perspective, because you are the steward of so much, and particularly with transition being what it is, right? And the direction that it's going. So there's the stewardship of the individuals, the people, the investors, the founders, ultimately what you stand for as well as a fund, right? How do you as a leader balance that?
Yeah, we always say that, we kind of engage in this triple stewardship at transition. So there's the stewardship of the capital that our investors entrust us with. There's the stewardship of the companies, and there's the stewardship of planet, right? And planetary health and the environment. And so one of the reasons we set up transition was to demonstrate by doing that there's no tension, there's no contradiction between, doing the right thing, in our case, especially for the planet, and doing really well commercially. And of course, there are all kinds of tensions that emerge sometimes between those things. I think the luxury we have as a relatively small firm is that we can be quite picky about who we work with, the founders we partner with, the investors we work with. We don't have to do everything. We just have to pick the things that we believe in, that we see as, having the potential to, make our planet better and kind of contribute to, societal thriving and resilience. So that's how we look at it.
What's your take on things like certification programs for this kind of stuff? Do you hold any weight, to give them any weight, like B Corp or any of the ISO standards? Is that relevant, or do you set your own thresholds?
So I think they're useful, but not sufficient necessarily. We're a B Corp. Transition is a B Corp, and we went through that process, and we enjoyed going through that process. There's all kinds of discussions that come up along the way, right, as you work through that endless checklist, and you kind of start having conversations with your team about what do we actually feel about this bit or that bit, right? And so I think these certifications are useful. There's all kinds of standards, frameworks, ways of looking at this. But I think we tend to go kind of beyond those. A lot of these frameworks are very much geared towards corporate ESG programs, right? So it tends to be quite, programmatic, quite box ticky, and that's fine. But what those frameworks often don't capture is if you're really trying to go above and beyond and do things that can really move the needle, right? And kind of drive systemic change. That's not what they're there to do, really. They're there to just, hold people accountable to a set of often minimal standards, right? So I think it's great. We picked as our kind of main framework something called the planetary boundaries. That's an idea that comes out of the Stockholm Resilience Center, of the 9 planetary systems that need to be in balance for us to have a livable planet, right? And they're interrelated, of course, and there's all kinds of interesting connections between these planetary systems. The bad news is that we're kind of overstressing the majority of those planetary systems, right? We're talking about things like freshwater, chemical pollutants in the environment, ocean health, carbon dioxide in the atmosphere, etc. But the good news is that some of them are moving in the right direction. And, something like the ozone layer, which we used to worry about a lot a couple of decades ago, that's, doing much better now. And that provides a bit of hope.
Is there a contradiction there between the energy usage that AI requires and the sustainability that you believe in?
I think if you're engaged in any kind of early stage investing in companies and startups, you have to deal with AI and think about how you engage with that. When we began investing about 5 years ago, we were looking a lot at energy systems, renewables, batteries, minerals mining, all these kind of physical areas. Fast forward to today, it's no longer contrarian to invest in those areas. In fact, the kind of classic software investing that I did earlier in my career has fallen out of favor because there's a view that AI is going to displace all of that kind of traditional software model. What's happened, however, to your point on the energy consumption of AI data centers, the water consumption that a lot of people talk about, is that, we're kind of no longer dealing with the virtual world. We're dealing with real physical constraints to the deployment of these technologies, right? And so it's not that transition has, suddenly become an AI fund. It's that the world in which AI is growing exponentially has become a world where we need to deal more with the physical world and think about the constraints that we have, how we allocate those precious resources, how we kind of grow the pie. And so looking at the AI use of data centers, for example, the kind of insatiable demand there has driven all kinds of innovation around geothermal, around other more renewable sources of electricity, meaning that actually now a number of technologies that were struggling to become commercially viable are now being very seriously looked at. And so that demand has actually sparked a bit of a renaissance in renewables because there's, higher willingness to pay.
Can we get into the mind of the investor for a minute? Because I'm really fascinated by that, right? So you've been a founder, you've sat on the other side of the table. How has that shaped the way that you look at investments, the way that you assess things? You said you're, a nimble enough firm that you can be picky, but in that picking, how much of it is thesis, science, etc., and how much of it kind of leans back into the kind of lesser known stuff, the intuition?
I think the longer I do this investment job, the more emphasis I put on people, and it's a complete cliche, right? But I think the biggest mistakes I've made as an investor have been the ones where I've been in love with a market opportunity. I've been, excited about the potential for a product where maybe I saw a different vision than a founding team, and where maybe the team wasn't quite there. On the other hand, I've been time after time positively surprised when I've taken a bet on a founder or a founding team who've then, gone and completely changed the market they were serving, completely changed their business model, built a different product from what they set out to do and still succeeded, right? And those are the lessons where you have to look back and say, well, ultimately, it's about the people. You have to be analytical. You have to be rigorous. We're entrusted with making, well thought through, well informed, careful decisions. That being said, there is often an element of intuition or something that you recognize in a founder where they might spike in a particular direction. And that's sometimes what it takes to kind of get over the line in terms of building conviction on an investment opportunity.
And have you learned to tune in or hone that kind of intuition, is that skill, as it were?
Yeah, I think the biggest lesson there is spend time with people. Ultimately, I always advise founders that I work with to pick an investor the same way they would pick any other business partner. and a relationship with an investor can easily last longer than the average marriage, right? And so you really need to go into that quite carefully, and you don't want a shotgun wedding, right?
And what would a good investment look like to you? I'm thinking about people even like myself who've got, entrepreneurial experience and a new idea. How should I present an opportunity to you, or what are you looking for in people like me to decide whether it's a good investment or not?
I think the first thing to emphasize is that a lot of entrepreneurs look to venture capitalists as these arbiters of what you can and can't do, which is completely the wrong way around, right? We should be looking to the founders to tell us what's possible and then go along with their vision. But the first question I always encourage founders to ask themselves is venture capital right for my business? It's a very specific journey that you're signing up to, and is not for everyone. In some ways, you're hitching yourself to a financial asset class, right? Where you are expected to go on a certain journey. You need to grow very fast. And that's becoming more and more true, where we're seeing, some of these AI companies showing absolutely astonishing growth and speed of growth that we've never seen before, right? And if that's your cup of tea, and if that's the type of company that you're looking to build, and you want to grow your revenue 5-10x every year, and you want to keep raising more capital, and you eventually want to, take your company public, then great. Venture capital is here to help and to, go on that journey with you and alongside you, and kind of, help hopefully remove some roadblocks along the way, and kind of give you the resources that you need to grow like that. But that's not for everyone. It is a very specific way of building a company that, I happen to love, and I've been on that ride many, many times. But I've also seen founders that have, 2-3 years into that journey really regretted that, right? And decided to switch gears. And so I think alignment is one of the most important things in any relationship, and in the relationship between an investor and a founder, the alignment on what's the journey ahead, how are we going to do this, how hard do we want to run, how much more capital do we want to raise in the future. That's really, really important.
And what does that look like when someone decides to switch gears? Is that like a messy divorce?
It can be, I think, in our case, or in my case as an investor, I've always kind of just let the founder set the pace, and then we'll support founders and, whatever they want to do, right? You can't force someone to go on a particular journey if they don't want to do that. Different things can happen, right? Founders might sell the company, right? We might help them. I think ultimately, no one investment is worth, more than our reputation, in the sense that we're not going to go in there and start pushing against the grain if a founder doesn't want to, go in a particular direction. But of course, the easiest thing is to, just build the business differently from day one if founders don't want to do that. But it is very exciting to grow very fast and go from 3 people to hundreds of people to thousands of people in 4 or 5 years, right? And that's what we're seeing.
And it's interesting because you've been an entrepreneur, you've seen that growth pattern, you've done that, and now you're investing and working with founders. Do you ever get that excitement where you want to get involved because you've been on that journey, and then you've got to kind of, how do you balance that, being the investor versus this is really exciting, let me come in and help?
Yeah, I'm often asked, does having been an entrepreneur make you a better investor? And you see a lot of entrepreneurs who become investors and succeed. And you see a lot of lifetime investors who are really excellent investors, right? I don't think there's any kind of clear pattern to that. I think the benefit of having been a founder myself is that I have a a great deal of hard-won empathy, right? Of what it's like, how lonely it can be, how difficult it can be, dealing with the doubts, the naysayers, people who tell you that you're wrong, people who ask you, what are you doing? You could have a great career doing something else, making fewer sacrifices, etc. Right? So I think the empathy on just the loneliness of that journey really helps with the personal relationship and kind of being there for founders in a way that they need it. I think a pitfall that founders often fall into as investors is that we tend to have that tendency to want to roll up our sleeves and go in and fix things, right? And be heroic about it. And you see something and it's not quite there, but if I just spent, 6 months or a year working with this team, I could really set this thing right. Usually that doesn't work out. Being high agency is great, but as an investor, you're sort of a backseat driver, right? You have to influence via diplomacy. You're not the boss, right? You have to make good arguments, have a relationship that's trusting so that founders might take that advice on board. But ultimately, there are some lessons that we just have to learn the hard way ourselves, right? And someone might tell you something 10 times, but until you've gone out and tried something and made some mistakes, you don't really internalize the lesson. And so then it's pointless for an investor to go out there and push in a certain direction when, ultimately it's the founders that are in charge and that run the company.
So that sounds like a really sort of evolved case of self-awareness, and I'm curious about how much you've grown since launching your own company, and also how much you've grown since working with Dip.
So I'd say, my growth journey with Dip began how many years ago now? Must be 7, 8
Must be at
years
least,
ago,
yeah.
at least. And I think having that space to completely openly reflect and have someone hold the mirror up to you, call you out when you need to be called out, very importantly, is an amazing way to accelerate growth, right? I think we often keep making the same mistakes, and you can't really break that pattern until you have someone that can work with you to identify what's driving those mistakes, for example, right? And so I think that's been a great growth journey. Venture capital takes a long time. The feedback loops last a very, very long time. We might make an investment and then it might take 4, 5, 6, 7 years until we really know for sure whether it was a good investment. And so having these intermediate opportunities to get feedback, to reflect, to take, lessons, to learn from things along the way is so important, because otherwise, if I just wait around to see how the portfolio I'm building now works out, that's going to take me a very long time to learn anything.
And you started Transition with your brother. What's it like being in a family business?
First thing I would say is we're not a family business.
Okay.
we're a partnership that happens to have a couple of brothers in it.
Yeah.
But which I think is an important distinction, right? The whole reason we set up Transition, we brought on board partners that are not called Helgason, is that we wanted to build something that could be multi-generational, that could really outlast us, right? But to what it's like working with my brother, I think the most amazing thing about that is that with people that you know less well, even if you've known them for a few years, you're always kind of in this mode of thinking about how will it be received? How will it impact my relationship if I communicate in this way or that way? I think with a brother, it's sort of, you can cut through all that, right? You don't need to couch things in a certain way. You can be very direct. And as someone who, at various times in my life has struggled with directness, it's a great blessing to be building a business with someone that I can be direct with, and where I don't have to worry about how I phrase things or how I say things. And so that's something that we try to encourage on the team more broadly as well, right?
And what happens if you don't agree? If there's conflicts, if one of you wants to do something and someone wants to do something else, how do you manage? And
they wrestle.
That would have been a few decades ago, maybe. I think we just have it out, right, and just discuss it. I think we've had very different paths through life. We have very different strengths and life experiences, business experiences. So there is a kind of natural division of responsibilities and kind of areas of expertise where we can defer to one another. And I think that helps a lot. Had we had the exact same experiences and professional background, there might have been more overlap and a kind of different space for disagreement. But given that, he built an absolutely iconic company from scratch, I, came up through institutional venture capital, and learned, a very different set of lessons there. And so those two, sets of experiences are highly complementary and kind of mean that we often defer to one another and in areas that each of us is better placed to be expert in, or to know something about, or have experience in. And then, if we disagree on an investment, we disagree. We have an investment process, 4 votes by each of the 4 partners, and that's kind of the ultimate tiebreaker, right? It's kind of, okay, well, we've discussed this, and now let's just vote, and we see how the votes fall. And I think it's really important to have a kind of objective resolution process. And ultimately, decision-making in the investment business is sacred, right? You can't allow ego to get in there. You can't allow politics to get in there. You really have to make the absolute best decision with the information that you have at hand, because we're already dealing with a world of uncertainty in investing in early-stage companies. And so, having a kind of objective way to settle the debates that we have as a partnership is really helpful, because everyone accepts that that's the process. Everyone accepts the outcome from the process. And then there's this, disagree but commit thing that comes in, which is, okay, we might have disagreed. I might be against this investment, for example, or be lukewarm on it. But if we as a partnership decide to make an investment, then I'm fully bought in, and I'll do whatever it takes to help get it done.
And can I ask that question that I tried earlier? Like, what does a good investment look like to you?
So I think, it's always difficult to talk about these things in the abstract. So maybe I can talk about a specific investment to kind of illustrate this. So a couple of years ago, less than 2 years ago, we invested in the seed round of a London-based company called Olix. What Olix has developed is a photonic compute chip. So where computation today in data centers for AI inference or AI training, AI inference is done in processes where you push electrons through semiconductors. There's an alternative way to do computation, which is to use modulated lasers in a little box. And the benefit of that is that light is very fast. It creates less friction. So you have less heat loss. You need less cooling. And ultimately, you can run the same inference as, through traditional means, but using only 10% of the electricity to get it done. So to your point on the electricity use of AI, this is, one very, very promising solution to that. The company was founded by James Dacombe, who I believe he was about 24 years old when he set up Olix, and it was his second company. So he's someone who's a true entrepreneur, founded his first business at age 16, 17. That is a medical device company that's gone on to be very successful as well. And so, he took some of the insights from that business to setting up Olix. Now, I think it's kind of emblematic of a really, really strong entrepreneur who has some unique insight, is very, very driven to solve a problem that's very big, right? And where the prize for solving that problem is massive, right? You look at the market cap of a company like NVIDIA, the reason that's so valuable is that they have the current best solution or a solution to the same problem. And so, that's a kind of configuration that we really like. The company's since done very well, huge valuation. They've raised hundreds of millions since our initial investment just last year. And so that's a good example, I think, of, a phenomenal entrepreneur with some unique insight, solving a very big foundational problem that touches almost every sector of the economy.
That was a good investment, looks like. Is there a version of that where it's gets the returns but is considered a bad investment? So you get the growth, you get the returns, but is then considered a bad investment?
I mean, if the company does something really bad or ends up having a negative impact on the environment or something like that, I guess that's the obvious case I can think of, an investment being a bad investment, even if it delivers a good financial return. Ultimately, we're here to do things that, benefit the planet and society. And if we have an investment that somehow goes against that, that's not good. And, we live by our reputations as early stage investors. And so I think, thankfully, that's not happened yet.
And you said earlier that, being the size of firm, et cetera, and the way that you are, that ego isn't really the thing that we put out the door. We have a robust process, making decisions, et cetera. How do you manage this might be a strange question. How do you manage the egos of somebody who's kind of like, growing, and that you've got a founder who's maybe getting ahead of themselves? And
look, I mean, people are different, right? And everyone has their own idiosyncrasies, and you just have to take people as they are, right? And accept them for who they are. You're not going to change the way that someone is wired, right? You have to find a way to work with them. And it's not my job to manage their egos, right? That's their own problem.
What happens when it does go bad? Does that affect your conviction or your decision making for the next time, or can you just brush it off and move on easily?
I think that one of the hardest things about this job is managing our own psychology. It's keeping a cool head when things are noisy and hyped the way they are right now in certain pockets of the AI market, right? Where there's a lot of money sloshing around, there's a lot of heat, there's a lot of noise. I think, as an investor, I've gone through these ups and downs in terms of my confidence, right? Where if you have a couple of companies that don't do so well, you start questioning, what is it that I got wrong? And I think the important thing is to respond to that by always kind of taking an objective look at yourself and really interrogate, what was it that drove that decision? What was it that I didn't get right? And take the right lessons away from that, which is why, as a firm, we, meticulously document all our deal flow conversations, investment committee conversations. We log all our votes so that we can go back in 2, 3, 4, 5 years and audit, not to hold anyone's feet to the fire, but to collectively learn something from what was it that led us to making a great decision. In this case, should we do more of that maybe? Did we take a kind of leap of faith on the basis of something that we should be paying more attention to? Or what was it that we didn't foresee about this investment, where maybe the market turned against the company or execution didn't work out or whatever it is, right? And so I think it's always about staying objective, taking the right lessons, and not getting overly emotional about it, because you start getting emotional, it starts clouding your judgment, right? It can lead you to taking the wrong type of risk. It can lead you to not taking any risk at all, which is equally dangerous, right? And anything in between.
What do you think about, how do you compare macro versus microeconomics when you're looking at an investment situation? So, for example, I'm thinking Warren Buffett, famously contrarian investor, will kind of enjoy going against the consensus, the popular opinion of things. And right now, it seems like everyone's piling into AI and tech startups, and especially in Austin, it's the topic of every conversation here right now.
Yeah.
And it feels like there's only it feels very bubbly from a macroeconomic perspective, right? It's got all the markers of historical bubbles right now. Does that influence your decision making?
Historically, some of the best tech companies were founded during downswings or, were built in an important way during tough macroeconomic periods. One of the luxuries we have being such long-term investors is that we don't have to pay that much attention to the macro. As macro cycles come and go, our fund life is 10 years. If founder is building an important company, an important product, has developed an important technology, they'll grow through any cycle. They might grow on a steeper growth curve during a boom cycle, and the growth curve might be less steep during a downturn, but they'll grow. And so we don't spend much time at all thinking about the macro. We think about it in terms of, when should our companies be thinking about IPOing? Is there a better time to, position a company for sale if that's what the founder wants to do during a kind of strong macro period? Do we foresee a downturn in the next 6 months that means that we should be advising our companies to take whatever capital is available to them to build a war chest in case it gets more difficult to fundraise in 6 months? But as a firm, our job is to find a few exceptional founders every year. We make maybe 10 investments per year. I think actually on the micro versus macro point, by far the most useful course I had at university that was related to economics was economic history. In microeconomics, where I always struggled to pay attention in the lectures, you get a lot of pricing curves, you get some, analytical toolkits that help you kind of, do some back of the napkin estimates and kind of reason through economic decisions. But actually it's economic history where I studied industrialization. I studied, the internationalization of economic growth and the emergence of the global economic system and things like that. That's much more useful to think about, how is AI going to affect the economy at large? What do new technologies mean for the development of certain industries in certain parts of the world? So I think economic history is my top pick for anyone that wants to be a venture capitalist, because it really helps put some real stories, real companies, real decision makers behind what can become very abstract if you're just looking at equations.
So with that in mind, what are you seeing on the horizon for the future?
I have no idea. I sit there at the office and I wait for founders to come and tell me, and then I kind of engage with their vision and come up with my own view of whether I think that makes sense, and that's a lot of the discussion that goes on among the team, is really kind of stress testing or really kind of, thinking through the hypotheses that we're being presented with by founders. Of course, we have some ideas of where things are going. The demand for compute is, growing exponentially. We have a number of renewable technologies that are now massively cost competitive with the fossil fuel alternative, right? So if we look at the precipitous drop of the cost of solar plus batteries, it's amazing to see how quickly the cost curve has come down, meaning that in large parts of the world, probably most parts of the world, the cheapest megawatt you can put onto the grid is solar plus battery, for example, right? So unlike 10 years ago, or even 5 years ago, where people were still debating, does solar make sense? Is it ever going to help us power a large part of the economy? Look at today where, there are a number of countries that are more than 50% renewable now. And so I think the framework that I put on thinking about, what's going to happen in 5 or 10 years is very much looking at what's the direction of travel today and what do those exponential curves, whether it's cost curves coming down or demand curves going up, as in the case of AI, and how extrapolating that, right? And kind of thinking through what knock-on effects that will have. And that's where I think that, we tend to have, I forget who said this is not an original thought, but we tend to kind of massively overestimate the impact of new technologies in the short term and massively underestimate the impact of new technologies in the long term as a result, right? And so I think, a lot of the naysayers on AI right now who are saying, oh, it's not actually that powerful, it's not going to do that much, is because, sure, today we're still really figuring out how to engage with it and how to use it. But the rate of improvement, the rate of development, the how early we are in the adoption curve for a lot of these technologies means that there's a very long way to go, and all kinds of things can happen along that path.
I think you're exactly right, obviously. And I'm curious about your view around future employment prospects for people. Do you buy into the theory that basically everyone's going to be unemployed, everyone's going to need to have some sort of universal basic income, or is there going to be a new industry, like, a bit like the Industrial Revolution, how that revolutionized farming to industry over a course of a long time? This is happening very quickly. What's your view on that sort of socio-economic change that's coming?
I think the reality is that because of the rate of development of AI, that increasingly there will be more value flowing to the owners of these assets, right? And so that's very clear. There will be some level of dislocation in job markets and the destruction of jobs. But the same way as I never bet against technological innovation to get us through difficult crises like the climate crisis or other problems that we face, I wouldn't bet against human ingenuity and kind of reinventing how we spend our time. Maybe we will have a growth in the creative industries. People will have new jobs to do. There will be, different ways of thinking about constructing a career, right? We're already seeing that with the growth of the creator economy, podcasters like you guys, right? Being able to, build something that, was impossible to build even 5 or 10 years ago, right? So I think new technologies create new opportunities. I think it's about staying nimble and obviously making sure that, the kind of the problematic effects are managed somehow. But that's a question for politicians, not for me.
So Ari, I've known you for a long time, right? And I'm really curious, like what is it that, having seen the journey you've been on and a life journey you've been on is fascinating, right? Born and raised in Iceland, and then to where you are today, founding, starting and running a very successful fund. What do you trust in yourself most?
That's a very good question. I think probably what I trust most in myself, and what has stood me in very good stead throughout my my journey is being able to find good, aligned people. Ultimately, you don't build anything without getting great people together. You don't, find interesting companies without finding, great people. It's ultimately capital. I've never seen capital build a company, right? I've seen a lot of people build companies. And so I think I tend to trust my judgment on people, and are they motivated by the right things? That's a big part of any conversation leading up to an investment is, what fundamentally drives you? Why are you doing this? And are we aligned on that? And so I think that's something that I tend to trust my judgment in that respect.
And so if you kind of reflect on that journey again, was this the dream? Would 10-year-old Ari?
Not at all. In fact, I remember at university, I was thinking about getting into NGOs maybe, or joining the UN. I studied international relations, and business was not really on my horizon. I remember making websites and coding games and making little apps when I was a teenager, and it was around the .com boom, and I remember feeling this sense of FOMO. Wow, it'd be cool to build one of these internet companies. And I remember walking along on campus and with a friend and seeing this poster, which was advertising a conference by the student-run Asset Management Society or Private Equity Society. And I said, oh, it would be cool to check that conference out. And my friend just laughed at me and said, Ari, what do you know about private investing? What are you doing there? So I really had no idea about what it would look like. But it was, once I graduated, I think I came to the realization that actually technology was going to be such an important driver of, social change and be, the most impactful probably area of the economy by far. And I was excited to get involved in it. And then, investing was just kind of a way to keep scratching that itch without having to run a company of my own.
So because I know you, I'm going to ask this question, right? 'Cause you began in fashion and apparel, and there was that creative kind of side of things.
Yeah.
Is there still a little bit of that itch to scratch, that kind of creativity?
So I think, everyone should have a creative outlet. I speak to my kid about this, that, we go through life consuming and creating, right? And the goal should be to have a good balance between creation and consumption, right? And not define ourselves by what we consume, but also put something out there. And I think creativity and creation is, back to the title of the podcast, in some ways sacred, right? And we all have it in us. And so, I think I'd be remiss if I didn't find ways of expressing myself creatively.
Ari, before we've got a quick fire segment where we just bang a few questions at you. Just before we get into that, one last question I'd like to ask is, is there one that got away? Is there a sort of a moment that you kind of wish you'd done something that you didn't, or you wish you hadn't done something that you did?
I'd say in early stage investing, there's multiple ones that get away every year. And I think the important thing is to not stew or dwell on those so much, but to, in the spirit of what I said earlier, take the right lessons from those situations. But yeah, I mean, there's constantly investment decisions that we're making where we're maybe not pursuing something, choosing not to pursue something, that we then turn back a year on, 2 years on, and look back and ask ourselves, what were we thinking, right? And those lessons are are hard, right? Because we're all very competitive. We do this to be the absolute best at what we do. And so when we get it wrong and a company gets away from us, either because we decided to let it go or we, in a competitive situation, we're not their preferred partner, those are always painful. But, it's you have to learn to just dust yourself off and take the right lessons from it and move on.
So each of these questions is designed to be just a first thought that comes to mind. Short, quick answer. Don't overthink it. Best piece of advice someone gave you before they wrote a check into a company you pitched?
I'll share a bit of advice. It wasn't from an investor as such, but when I founded my first business and I was beginning to think about hiring people, I called David and I said, I'm about to make some hires. What is your advice? And he just laughed and said, you're going to make so many mistakes. I don't even know where to begin. But the reason that's great advice is that you just have to do it, right? You just have to go out and not overthink it and not, be scared of making mistakes. You just have to throw yourself into it and actually do things and then course correct, right? Yeah. The most dangerous failure mode in building a business, I think, is indecision, right? And sitting on decisions for too long. And that way you don't learn, because you learn from your mistakes. You learn from good decisions and bad decisions. So you should just be making as many decisions as you can.
And I know David, and I can just imagine him laughing and saying that. That must have been hilarious. I love that he laughed at that. So one portfolio company that taught you something about your leadership you didn't expect, and what was it?
Look, I think there's, one particular company, I won't mention the name, but I think they were going through a tough time strategically. Something had turned against them where they really had to kind of completely change the business, and I think going through that quite tough transitional period with the founders really taught me how to not be prescriptive, because I think my initial instinct was to just say, we should do this. Let's do this. But then I think what I thought we needed to do was wrong. And the founders ultimately knew their business, their customers, their market context way better and much more in depth than I did. And so that taught me that good leadership usually starts with asking the right questions rather than telling people what to do. And that's a habit I've had to get out of. Is, I always have this instinct that I want to solve your problem. You come to me with a problem, I'll tell you how to solve it. Here's what you should do. But that's not leadership. That's just kind of me, scrambling to make myself feel better by feeling like I'm offering you a solution.
Nice. I learned that one through marriage.
That's also a good school.
Don't solve. Just listen.
What's the biggest myth most founders believe about venture capital, and what's the truth really?
I would say the biggest myth is that venture capitalists know better than you do as a founder, right? I see so many founders trying to adjust their pitch or even their whole business strategy to something that they think venture capitalists will like, often based on some offhand comment that was made by a very busy venture investor in a 30-minute meeting who, based on something they saw 10 years ago, thinks that this way to do it is the right way to do it. And I would say, listen to your own intuition and look at the information you have available to you. Because if you're out there speaking to customers, speaking to users, you probably know a lot more about what you're doing than a venture capitalist does. We might know more about corporate finance and fundraising and strategy and all kinds of things. But I think, there's this myth that venture investors are somehow these oracles who will, be the arbiters of what's a good business and what's not a good business. The founder's job is to prove those investors wrong by kind of going and doing something groundbreaking and new that no one had thought of before.
And it might sound controversial, but there's some investors out there who believe that they are better than the founders as well. They kind of carry themselves as they know the business is better as well. And that's an interesting stance as well, where they kind of pushing that narrative right onto the founders. So what you're effectively saying is stay true to what you know.
Yeah.
What I've seen from my limited experience with VCs, that's why I'm really inspired by you, Ari, is like, I think the 30-minute meeting conversation and the words that stayed with me was from a VC who said, every business basically has one or more of 7 problems. And it doesn't matter what industry you're in, what world, there are basically 7 business problems that all need to be solved at the same time. So therefore, as a VC, I've seen it all. I know how it all works. And, you can't touch me and I know best, right? And I chose not to work with that VC because that relationship wouldn't work. But that's the myth that I saw, was that a VC at least thinks they know everything. And it's encouraging to hear you say that the founders are actually the experts in their specialized areas.
And you are the experts in your specialized areas, right?
It's the same way that, if you're picking a business partner, you probably don't pick someone that has the exact same experience, knowledge, and skill set as you do. You probably want to pick someone that has a complementary set of skills and experiences. And that's, same goes for the founder-investor relationship.
Yeah. And that's the argument for diversity in all its glory, right? As well. Different mindsets absolutely. And different experiences, yeah.
So the planet or the cap table? When they're in tension, what's actually being asked of you?
I would say we all have to act with, ultimate integrity. We have overlapping fiduciary duties, right? We have, as investors and money managers, we have a fiduciary duty to our investors. As investors in companies, we have fiduciary duties to those founders. As board members, we have fiduciary duties in terms of governance, in terms of the employees, in terms of the overall well-being of the company, and kind of wider stakeholders. So I'd say there are all these concentric circles or overlapping circles of responsibilities that we have. And thankfully, our investors are very much aligned with our planet positive outlook. And so, there's no tension really there between doing the right thing. That's the whole reason transition exists, is to show that those two can go hand in hand and exist in harmony, that, great business and doing the right thing for the planet and society at large are not in tension.
And lastly, the one quality every founder needs that has nothing to do with their sector.
Resilience. As a founder, you have so many people telling you that you're wrong, that you're making a mistake. Why are you doing this? You should be doing this or that. And so being resilient, I think, is just, an absolute non-negotiable, because it will get difficult. There will be moments where you'll want to give up, where you think it's not going to work. Every single massively successful startup I've seen and been involved with has had multiple near-death experiences where they were running out of cash, something went horribly wrong, they lost an important customer, whatever it is. And if you don't have the resilience to push through those moments, you're going to be tempted to give up, and then you'll never know what you could have done.
The way you described resilience there's like a belief that sits behind that. What's the belief that sits behind that drives that resilience, do you think?
I think it's the conviction that you're working on something important, right? And it can be something important in terms of your values, a product that you think is important, that it needs to exist, something that you want to put out there into the world. A lot of the founders I work with, they're really doing their life's work, right? This is their thing that they have almost, been put on this planet to work on this thing, right? Well, that's often the sense you get. And I think when you have that belief in what you're doing, that really gives you the strength to power through. If you're just, building a business because you want to make some money, that tends not to give you that depth, those reserves of belief, because there are definitely easier ways to earn a living than to start a company.
Oh yeah, I totally agree. So it's been genuinely a pleasure to speak to you, and I've really enjoyed having you on the podcast. What's the kind of closing message that you'd like to leave on this podcast that would kind of be a nice way to close out today's conversation from your side?
I'd say there's a lot of cynicism in the technology space. There's a lot of cynicism about technology. There's a lot of cynicism about the role of technology in society. And I think the only way to solve some of the biggest problems we face is by developing better, cleaner technology with integrity. And if we don't have people with high integrity working on the technologies that are going to shape our future, those technologies are going to be shaped by people that don't necessarily have the best interests of the planet, of society at heart. And so I think, would love to see more young people going into becoming entrepreneurs. Some of the most amazing businesses that have been built in the last decade were founded by very young entrepreneurs. And so I think we just need more people building amazing solutions to the problems we face, and doing it with a strong sense of values.
Amazing.
Mic drop.
Thank you so much.
Thank you, Ari. It's been really great.
Thank you.
We've loved having you on the show.
Real pleasure. I enjoy the sound of my own voice.
You have a great voice.
No, thank you so much.
Unlike Derek and I, you have the face for TV. We have the face for podcasts.
Thank you so much for having me on and giving me this opportunity. It was a really fun conversation.
And if you've enjoyed this episode, like, subscribe, follow, share, do all the good things you need to do on all the social platforms. And more interestingly, let us know if there's someone out there that you think we should be having a conversation with. We'd love to get people that you want on the show. See you next time.